Hi, today I want to talk about continuation setups, which are setups that are going to happen after price puts a big move, strong move up. So what I want to see is the price is going to move within a range, and that range is going to contract until a point where there's like a small candle or a set of small candles and that make a very very tight range, and then price is going to add them to break out from that range, and as it breaks from that range, I'm going to enter the trade. Okay, so that's a basic concept behind continuation setups. Let me show you some examples. Okay, so here's one. Let's say all of this is a big move up. Let's say we take from here and there's a report that pushed price up a bit more. So here's one. It's not perfect, but it's a setup. So we have price moving up and then slightly going sideways and then moving up for a few days, and we have the concept of higher lows. So we have higher lows, we have a range, the range the price moves in that contracts as it respects the moving average until this point over here with this very very tight candle. This could have been a great setup if price broke out from this very very tight range that this almost like a doji candle put. Okay, so the smaller the candle and the smaller the body of the candle, the better it is. Okay, so in this case, it put a red candle or a black candle the following day, and then broke out from that tight range here this day. So big move up. You have a range. You have a respect for the moving averages. In this case, the 10-day moving average. As you can see, how it never closed below the 10-day moving average. Sometimes it's going to be a respect of the 10 and the 20-day moving averages, and you have a very tight range, and you have your higher lows. Okay, so that's what I look for. So it broke out here. So my entry could be in this day here. And then where is my exit? My exit is when price moves up from my entry, 4 or 5 risk units, entry minus my stop, which is typically half of an ADR. So when it moves 4 Rs or 5 Rs, so around there, I'm going to sell 20-25% of my trade. And then if price extends, like there's a like a strong movement here, if price extends from the 10 and the 20 moving averages, I'm going to sell another 20-25%, and then I'm going to sell the final whatever I have, 80%, 60%, 50% of my position when it closes below the 10-day moving average. The first time it closes below the 10-day moving average, I'm going to sell whatever is remaining of my position. I never hold trades below the 10-day when it closes below the 10-day moving average. It should be a very rare exception. If I think there is something that is moving the price, and I think like a very strong catalyst, or the stock is in a very very strong theme, and I think it might continue moving up, I may hold a small piece, like 25% or something against a 20-day, but it's very very rare. I'm going to say that probably 95% of my trades, I close the remaining part of my position when it closes below the 10-day moving average. Okay, so that was an entry. Let's see another one. So price continue moving up. Here made another strong move, not super strong, but somehow strong move up. And then again, you see how it respected the 10-day moving average. Okay, even this day over here, observe this. You see this hammer? It's called, this type of candle is a hammer. You see how it moved below the 10-day moving average, and it closed just to the limit of the 10-day moving average, because that's called reclaiming the moving average. It could be, anywhere just above. So it happens whenever price goes below one of the important moving averages, and then closes above that moving average. Okay, that means there are buyers here that are pressuring the price up. They're pushing price up, and they are beating the selling pressure. So we have a range that contracts. You see how price moves and oscillates in this range until the range contracts up to this point. So ignore the tails. It's important to mostly see the bodies of the candles, not the tails, because the tails, that means that, anywhere and any time during the day, price may, oscillate, may go like outside of the range, that, come back inside the range. So it's more important to watch the candles. You want to see, it's like the general intention of moving, within a range that contracts. So don't go like super crazy about, but price moved, outside of the range and then came back inside. It happens all the time. Okay, so we have a contraction. We have the high lows. You see, this is important. It doesn't happen perfectly anytime. You want to see, in general, you want to see that price is moving up. Sometimes, like here, you see there aren't like perfect, high lows, but you have your resistance here, which marks the upper side of the upper limit of your range. And then you have, higher lows here. You see how all this, the range, the price is moving in contracts up to this point with this very, very small, small candle with small body. That means the market reached equilibrium here. It reached balance. That balance was broken here this day after the report. Okay, so that's what you want to see. Okay, let's see more examples. So in this case, here is our base. I will always mark bases like this to see, where price is coming from, like having lower lows and then going sideways and then having higher lows. Okay, so that gives me the reference for where the last base is. It's always important to know where is the last base, where is the price coming from. So it's coming from this base, broke out here. Here it attempted to put, the first setup, which is always the first one. This could have been a potential entry this day here, not perfect, but could have, it would have worked. Okay, so we have this move. We have a range contraction here, as you can see. So again, don't look for perfection. Okay, it's the intention of the price. So price moved up to this day and then pulled back and then started to oscillate and put a tighter and tighter range. Okay, and we have our higher lows here, the other component, and we have a great respect of the 10-day moving average, as you can see here, how it almost like dances with this 10-day moving average, and then it broke out this day here from this tight range. Okay, and then moved up until this high and then pulled back, and for my strategy, my final close would be this day over here. Okay, as it closed below the 10-day moving average. So here we have another different, without a range contraction, a different setup, okay, which is a bounce against the 10-day moving average. So the important concept here is we have a sort of a range contraction here. This is called a wedge, and like a descending triangle, whatever it is. So you have a small move up. This is not very, very strong. I mean, it lasted just 3 days. It was a 23%, 22, 23% move. It's not, but it's good as an example. So you have a contraction here against the 10-day moving average. you have a little reclaim, almost like a reclaim here with 10-day moving average. We have a very small batted candle, so that means we have the equilibrium in the market, and then it broke out this day here. So this would have given me another entry, another opportunity to enter. So price moved up again for a few days, and then pull back, and we have again a volatility contraction. Okay, this could have been another entry. It's a bit far off the 10-day moving average. For me, the volatility contraction, the final candle or two, especially the final candle, has to be very close to the 10-day moving average. Okay, it can be far off from the 10-day moving average. If it does, and price moves or attempts to move far from the 10-day moving average, you have to see a lot of volume to sustain that move. If there is no massive volume, it is most likely is going to fail. Okay, it's going to attempt to move up, and then it's going to collapse, like happened here. So you have to see very, very strong volume like this. Like you want to see like 2x, 3x the average daily volume for a gap movement to sustain the move, like you have here. See, you have a gap, and you have like, this is like 5x or more the average daily volume. So you see how it sustained the move. So there were news released this day with a report that made the market buy the stock. Okay, so you have this resistance here, you have this base, and it broke out with good news, and then you have had this all this follow through. Okay, so again, if there is no high volume like here, you see you have a gap, and it had some follow through, and then continue moving up, never violated this low. So in order to sustain the move, the market needs very, very large volume, right? So think very strong energy to sustain the move. Otherwise, it's going to collapse, okay? Like 90% of the time or more. Okay, let's see more examples. Sometimes let me show you another example. Sometimes the big move up is going to be more clearly seen in the weekly charts, which I do look a lot. I will often have my weekly chart next to my daily chart. Like here, you see you have a big strong move up that is clearly seen in the weekly, and then you have a pullback against the 50-day moving average. This is another type of setup. So what I've shown you before is the continuation setups against the 10 and the 20 moving average, and this is against the 50-day moving average, which I consider like mini bases. These are like pauses against the 50-day moving average when price has moved up enough from the last base or the last pause against the 50-day moving average. Okay, so that's how price will move in the cycle. When price has went too far to, for whatever reason, you never know the reason, but for whatever reason, institutions plus retail considers that price has moved up too much from the last known base, the buying pressure is going to ease, and price is going to pull back, okay, to the 50-day moving average, and then it's going to pull some sort of setup. So what we see here is pretty much in the weekly is the same thing. So you have a volatility contraction, the higher lows, you have your tightness here, a very tight candle, very small candle with a very small body, and then we have a breakout. Okay, so it's the same thing. Now let's go to the daily so you can see it. So as you can see, this is like a full leg of a stage 2 in the price cycle, and then you have your pullback and you have your oscillations. It's price is moving within the range. We can draw it here. So it's you have your lower highs here. You see how the range is contracting, and it's contracting here to this day over here. And here you can see how you have this very, very tight, very, very small candle. So the entry would be this day, although it fell a bit shy of breaking like the this resistance, like the upper limit of the range. And another opportunity to enter would be the next day. Okay, so this happens all the time, where you're going to see that price is going to attempt to break out of a range and is going to fall like shy of breaking the range. And then you can either, I mean, this is what I do, of course. I'm not going to tell you, exactly how you have to do it, but this is how I do it. Is I'm going to either add them to buy this day, and if it closes with enough volume is like above average and above the previous day's volume. Okay, so if there is enough volume, I may hold a position and see what happens the following day. Or I can take my chances and wait for the following day and see if there is more volume, which will probably happen if price is going to move farther, like opening and moving farther from the range like we have here. You typically will see more volume. Okay, so more energy is needed to break out from that range the price was moving inside of. Okay, so this is what happened this day here. So this move wasn't successful. Market pulled back with the report, but the intention was right there. So what we have here is another very fast setup post base breakout. In this case, was the the pulse against the 50-day moving average. This is what I mean, that after you have a nice base and price breaks out, it's going to pull back typically to the 10-day moving average before make another move up. Okay, so you have your breakout move here, you have your pullback against the 10-day moving average. 2 days of contraction. This happens a lot of times, and I encourage you to go and observe. Like we had here, we have like a bit more, like we have 4 days of contraction and then started to move. But typically it's going to be like 1 to 3 days of tight or small candles before price items to move again. Okay, so whenever you see a base breakout and you see the price moves and you think, oh, it's moving without me, don't be discouraged. You just have to wait until price comes back closer to the 10-day moving average. Remember, I always look for contraction against the 10-day moving average, and this could have been another opportunity to enter. Of course, it failed, but it doesn't matter. The setup is good. Let's see more examples. This is HiMC, which is a gold mining company and had a very strong catalyst last year, which was the gold price was moving up. Okay, so we have our base here. We have our volatility contraction here. First item to break out was here without much volume. Let's mark it. So this day here, and then pull back, contracted again, put another very tight range here, and broke out here, also without a lot of volume, but it continued moving up. So again, there was a very strong catalyst behind this stock last year. So this is another opportunity to enter. Okay, so now let's go see some continuation setups. So we have our first strong move, 2 days, not super strong, but at least 2 days, and it moved 16%. Okay, not a big deal, but it's coming off a base. Okay, so again, this is the first setup, a very quick, very short setup against the 10-day moving average. We have contraction here. The next day attempted to move, pull back, closing in balance. Okay, this is a doji, so I can see that the range is still here. This is our resistance. our highs here, marking the upper limit of the range contracting, and here are our higher lows. Again, not perfect, but you can see that. Okay, so we have a respect of a 10-day moving average, we have our higher lows, we have our sort of lower, not very lower highs, but at least we have our upper limit of the setup, and broke out this day here. Okay, a lot of volume came in this day here. The first day there wasn't a lot of volume. Okay, so price moved up again here. Not the best linear move, but it moved with this high volume day here, which is something I prefer to see for the previous rally. For considering my continuation setups, I want to see big volume in the previous move. And so it moved like above the 10-day moving average. Okay, so it's kind of enough. Why? Because then it put this beautiful setup. You can see you have with these tails here, you have your range contraction is very, very clear, very easy to see. You see how you have this lower highs, and then you have your higher lows here. You can see how the range contracted from this all the way to this. Again, a small and tight and almost imbalanced candle against the 10-day moving average. Okay, very important. Most of my entries are with a small candle against the 10-day moving average. If it's far, and then let's say this candle was a bit far from the 10-day moving average, and then we have a gap, we will have to see massive volume to sustain that move. Okay, that's why I prefer to see, it's a lot easier for me to trade stuff that is, with a final small candle near the 10-day moving average. So we have a breakout here. This was a perfect entry, and I traded this stock last year several times, and put another leg. Also, another thing to see is you're going to see this, and this happens a lot, and is the previous move up, like the previous rally, and the resulting rally when it breaks out from that tight range, from the setup, are going to be sort of analog. They are going to be similar. Okay, so pay attention to that. So you can, it's almost like the previous move can give you a hint of what to expect. Another thing that happens is if you are closer to the base, the rallies are sort of, if this is a healthy stock with a catalyst, in my case, I look for stocks in strong themes, you're going to see that the rallies sort of expand. They are like bigger and bigger. Each rally is going to be, it's going to be like longer and stronger in duration. And then as you move farther from the previous base, rallies are going to, or tend to be, shorter. Okay, if you move enough, if there wasn't like a pause in between. That's why it's important to, if a stock is extended, unless there is a very strong catalyst, if a stock is too extended, you have to wait for a pause against the 50-day moving average, which happened here. So we have this rally, and then it got sort of far from the 50-day moving average, from the previous base, sorry. And this, you never know how far they're going to travel. This rally could have gone, all the way to here. You never know. You're going to catch some outliers every year, which could, be like 50 to 100 or 200, whatever percent moves. So whenever you enter a trade, you don't know how far the market is going to push price up. Okay, that's a very important concept, and that's part of swing trading. Okay, so here we were with this strong move. Now we sort of move far from the last known base, which was this one. So market decided to take a break against the 50-day moving average. Okay, so we have our resistance here. We have our higher lows sort of here, respected the 50-day, got close to the 50-day moving average, and didn't provide us with a good entry until this day here. Okay, so put two small candles against the 10-day moving average. Again, very, very important concept. And, almost imbalance candles. The opening and closing price are very, very similar, which means, price moved that day and then, it closed almost as the opening price. And it broke this day here. Okay. And put another very, very strong move up. This is an amazing move. As you can see, it never closed below the 10-day moving average until this day here. This if you enter this with a tight stop, this could be like a 40R, 50R trade. Okay, so as I always say, you don't need that many trades like this per year to have a very high performance in your account. Okay, so really it's just catching a few outliers every year to get a very nice return in your account. Okay, let's see another one. So price moved up just for a few days, pull back, and we have a different setup here. So we have this tightness against the 10-day moving average, small candles. Okay, we're standing here. This is harder to enter. Okay, I probably would have missed this move because it was I would have expected more sideways movement before putting a contraction, but it put up this 10-day reclaim a very, very tight range, as you can see here, and it broke out this day. So it was a valid entry. Okay, so we have another move up, and then we have all this sideways movement, sort of a price range contraction, which wasn't obvious until this day here. So if you're standing here, okay, you can see how price reached balance. Let me remove this, close to the 10-day moving average, and then broke this day here. Okay, so let me remind you again about volume. I want to see volume in the previous move up. Of course, it's not going to happen in every move. It's most important to see a strong volume in the first move, especially the first move coming off a base, okay, which happened here this day. And we had some strong volume here, but it wasn't a strong candle, okay? But anyways, there was a strong volume. There was strong volume again here in this move, okay, and paused. And we have strong volume here and here this day, okay? All right, so let me expand this a bit. So we are standing here this day. We have our tight range here, very, very tight range with this very small candle, okay? And it broke here. We had sort of, decent volume, like 25% above or 30% above average volume, and it was bigger than the previous day's volume, and it moved again, putting a rally. Okay, so we are here. We have our strong move above the 10-day moving average. Also, the less overlapping that you see in the candles, like here, these 2 days here, you see they're almost barely touching. The more overlapping you see in the previous move, in the previous rally, the better. Okay, that means there is more strength. So if there is volume and there is a strong move with not much overlapping, a lot of white candles or green candles, the better. Okay, so again, we have a resistance here. We have our price range contracting up to this point, Again, small candle, imbalance near the 10-day moving average, and then we have a breakout. In this case, if you put your stop below the lower day, you will probably be in the trade. In my case, since my stops are very tight, this day here would have taken me out most likely. So let me remove this. But I had another. If I'm trading this, I would have another chance here to enter. As you can see, price contracted again with a small-bodied candle. Price is almost in balance against the 10-day moving average, and I have all the high lows here, and then I have my resistance here. Okay, so I see that price is almost against resistance, contracting to this point with a very narrow-bodied candle, and then it broke out here. Okay, so we have a gap, we have volume, we have decent volume. As you see, the volume in the open, how strong it was, because it's not like a super strong volume, as you can see. Yeah, it's like 40% above average. It's kind of enough, but if it's like 2x, given that it's a candle, the better. And then you have to see if candle, let me see, if volume, sorry, let me see if I can show you that day. Okay, so we are here in the breakout day with the gap. See here, okay, how much volume there is. This is the open of that gap day. You see how much volume it is compared to the previous volume bars. You have very like unusually high volume at the open. That's what you want to see when you're trading a gap. You want to see very high volume, nothing shy. You want to see, like, in the first 30 minutes, I would say like at least 25-30% of the average daily volume. And sometimes you're going to see much more. The bigger the volume, the better. Sometimes when there is a strong catalyst and there are news released, you can even see like 20-30% of the average daily volume in the first few minutes. That's when you know that it's going to be a strong move. Again, it's gaps is another type of trade. I'm going to try to make another video and explaining gaps, but it's a different type of trade from continuations. Okay, so we have another move up, and we have our contraction. This one is a bit far, as you can see. The small bodied candle is a bit far from the 10-day moving average. Not crazy far, but it's a bit far. We have our range contraction. Let me see in the hourly, so you can probably see more clearly. Okay, so in the hourly you have your sort of range contraction. It's never perfect. Okay, but you have to see the intention. Okay, you have to pay attention to the oscillation and the contraction to a small bodied candle. And again, it's never going to be this perfect. Sorry, not never. It's not usually going to be this perfect. Sometimes it's going to be a bit harder to see it, but that's why you have to, do your deep dives and, spend your hundreds and thousands of hours watching charts and understanding how price moves. Okay, so we have a contraction, and then we have this breakout again, a candle, which is gapping up with like 2x or 3x the average. Actually a bit more. Like 2.5, 3x the average daily volume. Okay, as you can see, it was sustained until this high over here, and then price sort of collapsed again. Okay, because it was now far from the last known base, which is this one, and then the pause against the 50-day, which was this one here. Okay. So at some point, price gets too extended and it has to rest, and it pulls back. All right, I hope it's clear. I know there are many concepts There are, some are probably going to be new to you, and some of you which have more experience. Sometimes you have to be reminded of all these concepts. There are probably small things that I forgot to mention, but this is the idea. Okay, so you want to see a previous move up, you want to see an identifiable range that contracts, and you want to see a small body or two or three, but typically, but at least you want to see like one small bodied, or a very small. Sometimes the body is not going to be super small, but at least the candle is going to be small, especially if it's negative, like a red candle against the 10-day moving average. Okay, so remember, small candle against the 10-day moving average after price moving up and having a range that contracts. Okay, that's the basic structure of a setup, of a continuation setup, because you are expecting for price to continue moving up. Okay, so you have to come from a move up, which could last 1 day, 2 days with very strong volume, or it could last 5 days, even 2 weeks, 3 weeks, whatever. And the least overlapping in the stocks in the previous move, the better. The more volume, the better. All right. I hope it's not too confusing, and let me know in the comments if there are concepts that you want me to clarify, or other videos you want to see me explaining setups or bases or gaps or other stuff that I trade. All right, take care. Bye.